Hey, it's Jim, and this is level 3 of the CFA program, the topic on portfolio management and wealth planning, and the reading on trade strategy and execution. This is part 2. Let me just quickly remind you that we finished part 1 with a discussion on the linkage between strategy and execution and quantitative methods. Remember, we had a relatively brief conversation on clustering and lasso in which we were trying to examine huge data sets, and we want to shrink that down into manageable data sets from a trade strategy and execution standpoint so that we can make better decisions. Now remember, that clustering was you take all this stuff and you try to find little pockets of high correlations between and among all those different variables. With lasso, this is really a cool thing. We start with, just kind of regular, ordinary least squares, and then we assign a shrinkage coefficient, so to speak. Remember, we called that lambda. And essentially what lasso does is it sums all of those coefficients and says something like, you know what, we're going to penalize those variables that are not very important. And of course, if lambda turns out to be 0, then lasso turns out to be ordinary least squares. Now, I remind you of that because what we're going to do here in the very beginning is we're going to go ahead and look at that first red LOS, equity, fixed income, options, futures, all the stuff that we've talked about all the way back from level 1. So the Institute is really, really keen on linking and integrating LOSs from between and among different kinds of reading. So we'll start with contrast key characteristics. We'll talk about trade costs and execution and trading procedures. We'll go ahead and do some math. I'll show you some equations that appear in the reading, and they look like regular old equations, but an application in an example probably helps a little bit better than anything. Now, before we get into this contrast key characteristics of those colored boxes there, what I want to do is I want to read you one of the comments from the very first problem at the end of this reading. So this is a comment, and so the question then is, do you think this comment is correct or incorrect? Now I'm going to read this carefully. The high-touch agency approach, which we talked at length about back in part 1, is typically used to execute large, non-urgent trades in fixed income and exchange-traded derivative markets. That sounds perfectly reasonable, but I want you to be careful. The Institute does this regularly, and there are problems at the end of these readings. Notice, non-urgent trades in fixed income. Oh boy, that says, oh hey, yeah, that sounds pretty cool. But then, and exchange-traded derivative markets. My advice is to be careful when one of the comments in the vignette has the word and in it, something and something else. It's essentially two different questions. Now, I give you that example for a couple of reasons. I just explained the first reason, but the second reason is that when you are faced with an LOS that asks you to contrast or to compare, it really lends itself to one of those comments or statements or agreeing or disagreeing with some character inside of the vignette. All right, so comparison of markets. So we know all about these blocks, right? Equities, fixed income, exchange-traded derivatives, off-exchange derivatives, and then the foreign exchange market. So let's go ahead and go through these with a little bit more detail. And keep in mind that each one of these little blocks that we have here and here and here and here and here, each one of these is a potentially really good comment or statement on the exam. So what do we know about equities? And these things here are not going to be a surprise to you, right? Of course, they're more technologically advanced. Most of these trades are electronic. Go down to that bottom left there. Dark pools, this is a part of high frequency trading. Dark pools, this is a part of this movement since a law passed in the United States somewhere around 2005 to increase the opportunities for us as good portfolio managers to find the best execution price. Remember those dark pools, and they're called dark pools because we're not quite sure what goes in them. Somebody knows what's going inside of those things. But essentially, they're just trying to match customer orders inside of that dark pool. But the great question is that, you're anonymous when you go inside of that dark pool. Now, go back to the purple on the top right here, traded on exchanges. These exchanges, instead of being dark pools, they're generally known as illuminated pools. I think the term in the reading calls them lit pools because you guys watch news channels on TV or on your phone. When you go to the floor of the New York Stock Exchange, the lights are on, right? It's not dark. In equities, look over in the far right. There's generally a high level of pre-trade transparency because you can go to the New York Stock Exchange and you can see the bid and the ask prices, and you can make a judgment of whether or not you think those are fair or how that compares to the intrinsic value of that particular stock that you and I have calculated as a good financial analyst. Transactions and quantities are always reported. That sounds like an obvious notion there, but I want to call your attention. When I send you to those problems at the end of the reading, there's going to be a comment on that particular one there. Yeah, algorithmic trading is super common, especially for large, non-urgent trades. Boy, didn't we? I just read that in one of the examples. High-touch agency approach used for less liquid securities. We talked about that back in part 1. That we're going to go ahead and use human touch, right? High touch, when there's nobody in line to buy or sell the security for us. All right, how about fixed income? This is what we know. I say this to you guys regularly. If this is the equity market, this is the size of it. Fixed income market is this big. I mean, maybe it's even this big, and it has mostly to do with the U.S. government. What is the total amount of U.S. federal debt these days? Well, I know what it is, but I'm not going to share it with you because it has, whatever the number is, it has thousands of zeros afterwards. And so nobody can really comprehend what tens of trillions of dollars of total federal debt is. My point is that, of course, there's tons and tons of Treasury securities out there, but there are also huge amounts of fixed income securities that are issued by publicly held corporations. Now, when you go to the New York Stock Exchange, you go in line and there's probably going to be 100 people there. It's not physically 100 people, but in that order book and the flow book, there'll be lots and lots of activity. But not so in the fixed income market. There might be just one other person for this particular bond that has this particular maturity date and this particular yield to maturity, et cetera, et cetera. That's the second box there. Diverse securities due to varied bond features. Think about mutual funds, think about hedge funds, think about college endowments. They often hold to maturity their securities, or they trade them infrequently, which leads to that less liquidity and the lower transparency. Yeah, the dealers, they are super crucial to provide market liquidity. So they provide this market liquidity. Now, they may not provide market liquidity at the price that we want just because there's not as much breadth or depth. Yeah, there's a box on market illiquidity. High-touch trading is common for larger, less liquid securities. That makes perfect sense. And then brokers play a pretty important role there. How about exchange-traded derivatives? This was part of the example. So these are futures contracts and option contracts. They are standardized. Remember, I said this to you in some other derivatives recording that a futures contract is nothing more than a standardized forward contract that trades either on an exchange or in some over-the-counter market. But either way, they're super highly standardized, although on the exchange-traded futures contracts, they're completely standardized. So lots of volume. Lots of transparency. Notice down the bottom left, we're going to use electronic trading almost all the time. We're going to have some algorithmic trading, some, but not as much as the equity market. So that sounds like a really good comment or statement to agree or disagree with. Large non-urgent trades are mostly algorithmically executed. So combine that top right one and that middle bottom one there about algorithms. DMA, that's a super common practice for small trades. Over-the-counter derivatives, of course, these, by their very nature, over-the-counter means that you could get some that are unique or tailored to your specific needs. So if I go back here, look at that top left one there, high volume, highly standardized. Here, we still have high volume, and we still have high standardization, but we don't have complete and total standardization. This occurs through dealers, of course, instead of being on an exchange. And the brokers probably take some kind of risk, maybe lots and lots of risk. Look down at the bottom, raindrop liquidity, increased for standardized trades, decreased for unstandardized trades, or trades that are more tailored to meet those individual needs. Currencies, there's no New York currency market out there. There's no Memphis currency market. There's no Los Angeles currency market. So no centralized exchange. Multiple levels. I mean, you can go from all the way up to these, large investment banking firms, all the way down to me. I mean, I could go out and buy a million euros, and I could open up in my backyard. I could say, hey, anybody wants to buy some euros? I could probably do that. Now, the SEC would probably show up in my backyard and say something like, hey, Jim, what in the world are you doing? And I'll say, hey, you know what? I got my Mackinac peach trees right here. I'm selling the Mackinac peaches. Why can't I sell them to somebody over in Europe? Trades executed using algorithms. I try to take my students to New York to visit all the exchanges. We haven't been able to do that, with COVID and all sorts of things. But we get to do this every couple of years. And about 15 years ago, we went to an investment firm, and we went into their currency trading room, and it was so cool. And this one dude, the floor manager, he took me into his office, and he had a big couch, and he said, you know what, this is where I sleep most of the time because markets don't ever close. He goes, hold on a second. And he went to his computer, he pressed a button, and he goes, oh man, I had to execute that algorithm. So high touch agency using algorithms. Yeah, high daily trading volumes observed, right? The spot market. What did I say? Equity market is this big, fixed income is this big, spot market is, currency market is that big. All right, next LOS on trade costs are measured. I think we did a little bit of this back in part one. There are explicit trading costs. There are implicit trading costs. The standard measure of trading costs is this concept of implementation shortfall. So think about that word, shortfall. We've used that in other areas of the CFA program. Shortfall means that you just don't quite get there, right? Think about the golfers playing in the British Open. What do? They try to avoid hitting it into the bunker. And, sometimes they get into the bunker, sometimes they don't. So in golf, they want to stay short of the bunker, at least off the tee, right? They want to stay short of the bunker. Approaching the green, they want to exceed the bunkers and get on the green. So if they hit it into that green side bunker there, they have to hit it sideways, they have to hit it backwards, they have to hit it all sorts. So there are consequences to these trading costs. Let me just quickly go back to 1958 and 1952. Harry Markowitz, Modigliani, and Miller, we've learned about these dudes many, many times. What did they assume in their little worlds? They assumed that trading was costless. And that helped them arrive at things like an optimal capital structure and things like capital structure irrelevance and the efficient frontier with Harry Markowitz. So this is really all we're doing here with implementation shortfall. We're trying to figure out how much does it cost to trade from the instant, and I did this in part one, right? The instant we make the decision to buy or sell a security until the time that the trade is actually executed. And I think I emphasized this in part one. These things are measured now, not in hours or minutes or seconds, but in, super tiny fractions of a second. Now, implementation shortfall, this is a super easy equation here, at least on this page. It'll get a little bit more complex in a few minutes. It's really just the hypothetical return. The reading calls it a paper return minus the actual return. It's sometimes expressed in basis points, and I'll show you how to do that here in just a minute. So what did I say a few moments ago? There are some equations here. Notice there are some sigmas there, so we're going to have to sum a whole bunch of things. But notice some of the input variables, right? There's a price, and then there's another price. So look at the PD, price at the time of the investment decision, right? Compare that to the current price, and then S is the number of outstanding shares. Now, before we get into an example, let's go ahead and break down implementation shortfall into some of its components. And you can do this two ways. You can look at that first one under the green box. You can take the opportunity costs and you can add the fees, and then you can add a general execution cost. But look at the expanded implementation shortfall equation. You continue with the opportunity costs and the fees, but then you break that execution cost down into delay and a trading cost. Once again, notice that there are a bunch of summations in there, so we'll have to go ahead and get our calculator out and add. Here is a slide on the definitions for each one of these. Pretty self-explanatory: execution, delay, trading, opportunity, and fixed fees. Now the question then becomes, if we're a golfer and we hit it into the green side bunker short of the green, there's an implementation shortfall. What are the consequences, right? And how do we avoid this in the future? So of course we want to minimize the delay cost. So what does a golfer do? A golfer, at least the professionals, they have a caddy who measures off the distance. They put their finger up and they figure out the wind and what kind of club and all that kind of stuff. So minimize cost delays. How do we do that? By using efficient trading practices. That makes sense. Boy, I love this. Optimal trading strategy. That's why I just mentioned Harry Markowitz just a few moments ago. What's that? Efficient frontier. That's the optimal trade-off between risk and expected return. Well, essentially, we're doing the same thing here, but we're doing it at a super micro level, right? We're evaluating these things in milliseconds rather than Harry Markowitz doing this over, let's say, a 1-year time period. Now, of course, we need to worry about cash. We talked about this at length back in part 1 about cash drag, and that's essentially what's going on with opportunity costs. We need to do benchmarks. We'll talk a little bit more about that here in just a few moments. We did that back in part 1. And then look over in the orange box: efficient trading practices, appropriate deployment of unused cash, the use of proper price benchmarks. So think about that orange box over there on the right-hand side as analogous to Harry Markowitz's efficient frontier over the strategic asset allocation for the portfolio. So let's go ahead and work through an example here. We're going to buy 120,000 shares at 10 a.m. when the price is 40. All right, so there we go. Let me point to my temples again. Limit price of 40.6 for the order. The buy-side trader, for whatever reason, does not release the order to the market until 11:30. So what is that? 10 a.m. to 11:30 a.m. So there's a whole bunch of time that goes by when the price is 40.15. There's a commission there, 3 cents a share. At the end of the day, 100,000 shares are executed at a closing price of 40.8. So there's a summary. We're buying, there are the shares, and there's the limit price. Now, here's a box of how we executed these trades during the course of the day. Remember back here, what did we say? At the end of the day, 100,000 shares. So here's a summary of how those shares were purchased. Trade 1, 2, 3, and 4, 40,000, 30,000, 20,000, and 10,000. Those sum to 100,000. And then we have different prices there, right? Prices apparently are rising during the course of the day, from 40.3 to 40.6. All right, so let's go ahead and compute this execution cost. There's the blue equation that I saw before with the summation sign, but look in the green box. We write it out for you so it makes a little bit more sense. And then down at the bottom, we do the math. So what are we doing? Notice we're summing, so there have to be a bunch of plus signs in there. So we go back to, here, let me just do this. Go back to this. All we're going to do is do the multiplying, right? 40,000 times the 40.3, do all that, and then subtract, and this is important, subtract the 100,000, which is the total purchase, times that $40, because, let me go back here, right? At that instant, right, the price was 40, not dollars. It was a different currency there. So the execution cost there is 40,000. How do we do the opportunity cost? What we're going to do is we're going to say, wait a minute, that very first sentence asks us to buy 120,000 shares. All we did was buy 100, so we take the 20 times the difference between the closing price, which was 40.8, minus the $40. So there's 16,000 for the opportunity cost. And then the fixed fees, that's an easy 100,000 times the 0.03. So that's 3,000. So what is our implementation shortfall? Well, all we're going to do is sum those three costs, 40 and 16 and 3. That gives us 59. Then we can do it in basis points. One word of caution here, we've got the 59,000 in the numerator, but make sure in the denominator you put the full order amount, 120, in that denominator. So there we go, about 122 basis points. Let's go ahead and focus on those opportunity costs in the next slide. What the reading does for us is ask us the question that, hey, we've got all these opportunity costs out there. How can we manage them? And so how can we minimize the opportunity costs, reducing order size to match market liquidity? This goes back to what I was saying in part one. Are we showing up with a wheelbarrow full of cash or a dump truck full of cash? What we want to do is exactly what we did in this example, is have a trade 1 and a trade 2 and a trade 3. We want to, match that market liquidity, or we can use different execution strategies. So let's go ahead and complete our analysis of implementation shortfall. Let's go ahead and compute the expanded implementation shortfall. So we had equations for delay cost and trading cost on a previous slide. You can go back and refer to those if you want to, but here we go. We've got some really simple ones for delay costs. We take that 100,000 times the delayed price. Remember, we started at 40, then it went to 40.15, and we subtract out that original 40. So there's 15,000 pounds as a delay cost. The trading cost then is we're going to sum all of those executed shares times the executed price. So there we get, what is that, 25,000 pounds. And then we can use the 15 and the 25, combine that with the 16 of opportunity and the 3 of the explicit fees, and you get 59. Now, the Institute is very big on things like reviewing and monitoring and evaluating. We talk about this all the time, right? So how we do this in evaluating the execution of a trade is through this concept of a trade cost analysis. So this is really just a tool or a process to evaluate the execution of a trade. What it will do is measure the quality of trade execution. Think of quality meaning something like, hey, we have really good quality, which means, think about this. Suppose in our previous example that when we made that decision, the price was 40 pounds, and then throughout the day it was 40 pounds, right? And that it didn't change. What would be the quality of that trade execution? Well, that would be perfect quality, right? But we never get that. So what happens to the price? In our example, the price went up during the course of the day. So that's going to hurt us. What if the price goes down during the course of the day? That's going to benefit us. What happens if the price goes up and down and up and down? Well, this trade cost analysis is going to measure the quality of that. So you can apply this to, almost anybody out there, traders, brokers, and those who write and benefit from the algorithms. Really good exam question there on the green over on the far right. Better management of the investment cycle costs and an improved understanding of trading costs. Now, you guys have heard me say this many, many times. The Institute, they want us to achieve, a certain level of proficiency. And what that means is that the Institute wants us to understand. They want us to understand everything from Harry Markowitz, which I just discussed, from Modigliani Miller, which I just discussed, and then, of course, to understanding of trading costs. So let's take a look at a quick slide here, the role of this TCA. So facilitates communication between and among everybody that's important out there, right? Peer comparison, the Institute loves these benchmarking. We'll do that here in just a few slides again. Helps in the selection of which algorithm to choose and which broker to choose, and it's probably going to reduce those delay costs. We all know the Institute loves benchmarks, so we'll go ahead and add just a little bit to what we talked about in part one. Some of the possible benchmarks, the arrival price. We did this in part one. Value weighted and equal weighted, market on close, market adjusted. Look down at the bottom of those diamond points. Costs are expressed positively for underperformance, negatively for better performance, or think about it as savings. We'll go ahead and look at some equations here. Once again, it's probably just as easy to work through a quick example. Here's an equation for the arrival price. Here are equations for value weighted and equal weighted, although the reading calls that time weighted. Look in the second box there. Let me just repeat this. I think it's worth it, even though we did this back in part one. What we want to do is use this volume weighted if that fair prices were achieved over the trading period. For the time weighted, we want to exclude potential trade price outliers. So that makes sense. Here's the market on close equation. Here's the market adjusted equation. Here's the added value equation there in number 3. That's just arrival cost minus the estimated pre-trade cost. So let's go ahead and work through an example so that we can bring to life some of those equations on the previous page. All right, so buy order average price of $35.20, arrival price 35, the expected cost of the trade 45 basis points, the index price was 600 and the market index value weighted was 605. Stock has a beta of 1.15. So let me just pause here and remind you, hopefully I don't have to remind you of this, but I'm going to go ahead and do it anyway, that remember beta measures systematic risk. It measures the sensitivity of an individual asset's returns to changes in something else that's out there, like a market return. So what we're going to have to do is we're going to have to go ahead and adjust for this beta, which has, let's just think of it this way, it has 15% more market risk than that of, let's say, the entire market portfolio. All right, so you ready? Let's do arrival cost. Notice that first part of the equation is the side, so it'll be a +1 for a buy and a -1 for a sell. So all we're going to do is take the difference between those two prices. So there, do I need to go back here? Yeah, there's the market that was entered. The price was 35, and then 35.20, take the difference there, and then figure it out in basis points there. Just make the adjustment. So that's 57.14. What did we say back here? Where did I go back here? Where was that? Where was that? That was right here. All right, so costs are expressed positively for underperformance, negatively for better performance. So what does that tell us? 57.14. So there's order underperformance. How about the index cost? We're going to do the same inputs for the equation. There's the +1 and there's the 10,000 over on the right hand side, but now we're going to take the difference between that index value weighted, which is 605, and there's the index arrival, so that's 600. So there's 83.33 basis points. So this purchase is more costly compared to the market. So you get a sense of what we're doing here with this index cost. We're saying something like, let's go ahead and benchmark What did we do here? We just said something very unique or specific to this particular trade, right? That's kind of at the micro level. And then here with the index costs, we're going to go ahead and look at the macro level. What is everyone else doing out there as compared to the index? So we're underperforming here at the micro level. We're underperforming here at the macro level. Let's go ahead and adjust that for the beta. So let's take the 57.14 and subtract and adjust this, right? Market adjusted cost. Take the 115 times the 83. So that gets us 38.69 basis points. So that negative value tells us that we paid less for the order than expected, and which means that the algorithm outperformed the market. So, right, we're adjusting this for beta because just like we know, owning a share of stock that has a beta of 1, when the market portfolio goes up by 10%, then our individual security now on average will go up by 10%, not necessarily on a day or a weekly or a monthly basis, but on average it'll go up by 10%. But if we have a stock that has a beta of 1.15, we're going to increase by an extra 15%, right? So that should make perfect sense. How about this pre-trade adjustment? All we're going to do is compare the arrival cost to the estimated pre-trade cost. So we'll just use those results from our previous calculations. We'll take the 57.14 of the arrival cost minus those estimated pre-trade of 45 basis points. So there we got 12.18. That's positive, so that suggests underperformance. Now, we spent lots of time back in level 1 and early on in the corporate finance section in level 3 about governance, right? So think about this from a corporation's perspective. What does that mean? Good governance means that we have a really good board of directors who are talented enough to hire extremely highly skilled executive leadership team, and then they work on subcommittees together and they figure out all the stuff with the strategic plan. So let's go ahead and apply those understanding of governance that we've learned since level 1 and apply it to trade execution. All right, so good governance is key for compliance. Fair dealing, so that middle green box there, fair dealing, oh man, this takes us all the way back to our conversations on the code of ethics and all those professional standards. Once again, I'll remind you that these are great questions for the Institute to link standards of professional conduct with trade execution. And then look on the far right, of course, what are we trying to do? Minimize risk. In order to minimize risk, we have to, are you ready for this? You've heard me say this many, many times. We need to identify the risk, which we've been doing in part 1 and part 2. We need to manage the risk, which we've been doing in part 1 and now in part 2. Quantify the risk, which we just did, and then we need to manage that risk. All right, so think about minimizing risk in that context. Think about how this works with this document that we're putting together, regularly updating, reviewing, monitoring, all that good stuff. So here's another slide on this document here, this trade policy document. Clear articulation, right? Guidance on escalation procedures. What does this mean? If we're just swimming along and the current is with us, and our clients' portfolios are increasing in value by all those expectations given the risk parameters, then everything is fine. But what happens if things escalate? What if we get lots of waves, we have an undercurrent, we have a side current, we have sharks swimming out there, we got all sorts of things. So guidance on how to deal with problems that are going to arise during, let's just pick 2008 financial crisis. Let's just pick 2019 and COVID. Let's just pick 2022 and inflation. How do we deal with all of these macroeconomic factors at this micro trade execution level? Of course, we're not doing this in a vacuum. It's not just us and our brokers and our dealers and our algorithms and our clients. There are other people out there that are interested in our life. Think about these as the government regulators. All right, so what is the trade policy objective? this is not a surprise. Optimal execution. What does that optimal mean? I'll just go ahead and do this regularly. Marginal costs and marginal benefits. So best execution to clients, which of course swings back to our code of ethics. Key aspects of a trade policy. What is the meaning of best execution? What are all of the inputs or the factors that determine that order execution? We need a list, and this list is going to tell us about these eligible brokers and all of the exchanges out there and all of the dark pools out there. And we can rank that list according to what our definition of that best execution is over on the left-hand side. And then, of course, there's that great word that the Institute loves, monitoring. All right, so what does this mean for best order execution? Yeah, defined by relevant regulatory framework. So you got really, really smart men and women who work for regulatory bodies and government bodies, and they come in and they say, okay, here are the rules. Of course, the primary goal is to secure that best price at the lowest trading cost for each one of our clients, but it's way more than just that. So we need to worry about execution speed. Let me just remind you about what we talked in part one. In the old days, we had to run to the floor of the New York Stock Exchange. Now with all of the electronics, now we're measuring this execution speed in fractions of a second. Likelihood of execution. If you show up with a wheelbarrow full of cash on the floor of the New York Stock Exchange, or even if you dump it into a dark pool, you have no idea if this thing is going to be executed and then settled, mostly because a lot of times you don't know, especially in the dark pool, you don't know how many people are selling in there if we're buying. And then on the floor of the New York Stock Exchange, you don't really know the breadth and the depth of that order book. So likelihood of execution, that of course depends on order size, whether it's a buy or sell, whether there's margin involved, whether there are those other types of leverage involved. So how do we aggregate our trade policy and allocate it in an efficient manner? So what we're trying to do, equitable allocation of all executed orders. Remember back in our discussion in the Code of Ethics and those professional standards, what do we have to do? We have to treat everybody as if they were equal, right? So we can't allocate, 50,000 shares to this client and only 10,000 shares to this client if they both want to trade 50,000 shares. This is what I was talking about just a second ago, these next couple of diamond points, remedies for misallocations and allocating partial executions. This is relatively simple if we're swimming with the current, but when we have all these other waves and shark coming at us, we're going to make mistakes. So there's a misallocation. We're not going to be able to fully execute. So how do we prorate? How do we decide? How do we do all that kind of stuff? So this document is going to help us decide on which avenue to pursue. Yeah, transparent audit trails. Yeah, somebody should be able to come by after us and say, oh, hey, Jim, you did this and this and this. That was perfect. Even though you ended up losing, underperforming, whatever it is, remember, we're not going to outperform all the time. We're going to underperform sometimes. So what about a trade error policy, treatment of handling trading errors? Of course, we're going to make mistakes. Human mistakes, even algorithms somebody can pull the plug on the algorithm. I guess that's probably not too likely of an outcome, but something can go wrong, right? Yeah, we should document the errors. They should be resolved without client impact, right? We shouldn't have any bias in that. All right, factors for optimal order execution. We need to worry about the urgency. We talked about this back in part one. Do we have a high urgency? Do we have a low urgency? What are the security characteristics? This probably means whether they are standardized, what kind of liquidity they have, execution venue characteristics. Where are we going? Is it an organized exchange? Is it a dark pool? Investment strategy objectives. This links us back to the policy statement. I love that. I love that box. And then trade rationale. Let's go ahead and conclude with a subject that I briefly mentioned just a few moments ago. Remember I said that we have all these people inside of our organization and outside of our organization who are interested in our trade execution, but there's a third person out there, a regulatory body or the federal government. And so what the reading does is it emphasizes the SEC in the United States, the Financial Services Agency in Japan, but then this Markets in Financial Instruments Directive from Europe. And a couple of interesting things about this, one of which I talked about just a few moments ago was this concept of escalation. So remember I was saying, if we're swimming with the current, everything is fine, but then what happens if we have lots of waves and sharks? Well, what this directive does is it says, all right, let's suppose that this trading document is not complete enough for us to handle, what if we have two sharks attacking us at the same time? This trade document says something like, okay, if the waves are a little bit higher and we're having difficult executing this particular trade, maybe it's because of some of those factors, like inflation and COVID, maybe it's those factors, but maybe it's something that's going on with the floor of the New York Stock Exchange or some other kind of an outlet. Well, then what happens when we have to escalate that? Who else is out there to help us? So, we escalate and we can go to one of these regulatory bodies to help us resolve these issues. All right, so what we talked about just a few moments ago, coupled with what I'm just talking about here, pretty much explains what this directive does. And the Institute, at least in this reading, emphasizes the European regulatory body. So look at those first arrow points there. Requirements for best possible result in executing client orders. All right, so that's paramount. Then we go back and link to our code of ethics and a prohibition of those soft dollar arrangements. We've talked at length about this. What does this mean? You can have the hard dollars and you can have the soft dollars where, some kind of fees are coupled with services. And so this directive here prohibits that soft dollar arrangement. All right, key considerations. Let's go back to that very first LOS, at least in part 2, with these different types of securities. What are key considerations by asset class and how we can handle these possibilities of, well, look at the LOS, processes, disclosures, record keeping. All right, so with equities and exchange traded options and futures, we need to worry about which particular market, what about the liquidity, how that historical transaction data can impact the execution. For fixed income, we love market transparency, we love price discovery because fixed income markets are generally a little bit less transparent, they're a little bit less broad and a little bit less deep. Yeah, over-the-counter derivatives, this is a little bit more interesting because we can tailor, we can customize these, so we need to worry about all different sorts of other things. What are the terms? Right there, look in the purple box, the terms of the proposed instrument. And what I tell my students when we get to this conversation in class is, in order to make this optimal choice of a broker, it's best to compare the terms that you can get in the over-the-counter market with the standardized terms on an exchange. We need to worry about default risk. So what does the Institute call this default risk? They call it counterparty risk. They call it third-party risk. They might even call it operational risk. So we need to expand our risk management procedures to include all these other extra things that we need to worry about because we get the opportunity to customize our order. And then, of course, what did I tell you about currencies? The market is this big, so we don't have to go here or here. We got lots and lots of choices. So we need to, what does that box say? Multiple independent dealers. How about that list of eligible brokers and execution venues that I talked just briefly about here? Yeah, predefined criteria, what's most important to us. And that goes back to our definition of all of these input variables. Quality of service, stability, ethical reputation. What did I say just a moment ago? I'm going to go ahead and open up my own currency market in my backyard next to my Mackinac peach tree. Well, what kind of financial stability do I have? Probably none. What kind of ethical reputation do I have? Maybe a high ethical reputation. At least let's suppose that I have that reputation, since I do hold the charter. Brokers' willingness to commit capital. This is probably important. Selection process is consistent among and across all asset classes. And then this list should be distributed to all parties involved in that trade execution. What does the process look like? Boy, we're going to see words here that the Institute loves: monitoring, reputational risks, reviewing, ongoing monitoring, reporting, minimum requirements, best execution, monitoring committee. This links back to good governance, right? We talked about good governance at the corporate level. Now we're talking about good governance at the micro level. So we need to distribute this to all of those people out there, and we should have a committee that monitors this. All right, so that takes us through part 2. We've done all of these LOSs. What I want you to do now is take, let's say, 42 minutes of your time, go to those 24 or 25 problems at the end of this reading. Keep in mind that there's a host of agree or disagree with comments or statements, and there is a host of calculation questions, so you should be able to handle those pretty well. So good luck on this little mini quiz. Good luck studying. Thanks for watching, and I'll see you next time.